Hello everyone, welcome to the March 3rd Tuesday edition of the Market Opening Bell, your 10-minute guide to the stock market. The US military continued its airstrikes on Iran on Monday, sending oil prices surging and dragging down Asia-Pacific stock markets. Hong Kong stocks followed the external weakness. The Hang Seng Index opened 324 points lower, with the decline widening to as much as 747 points at one stage, hitting a low of 25,882 points before closing down 570 points or 2.1% at 26,059 points. The H-share index fell 157 points or 1.8% to close at 8,701 points, while the Hang Seng Tech Index dropped 148 points or 2.9% to finish at 4,989 points. Total market turnover reached 357.6 billion Hong Kong dollars. Southbound trading turnover totaled $154.7 billion, while southbound funds recorded a net inflow of $16.214 billion, up from a net inflow of $14.997 billion the previous trading day. Among the net purchases were the CSOP Hang Seng Tech Index ETF at $3.123 billion, the Tracker Fund at $2.447 billion, Xiaomi at $1.629 billion, the Hang Seng China Enterprises Index ETF at $1.532 billion, CNOOC at $1.375 billion, Tencent at $782 million, Yangtze Optical Fiber and Cable at $207 million, COSCO Shipping Energy at $203 million, and Shandong Molong at $128 million. On the net sell side were Alibaba at $1.389 billion, Meituan at $244 million, and SMIC at $154 million. Statistics show that southbound funds have now bought Xiaomi on a net basis for 7 consecutive days, totaling $5.197 billion. The three major A-share indexes opened 0.3% to 1.6% lower and then traded mixed. The Shanghai Composite Index recovered from its early weakness to close up 19 points or 0.5% at 4,182 points. The Shenzhen Component Index fell 29 points or 0.2% to close at 14,465 points, while the Chinex Index dropped 16 points or 0.5% to finish at 3,294 points. Combined turnover on the Shanghai and Shenzhen markets reached 3.02 trillion yuan. The renminbi central parity rate against the US dollar stood at 6.9236, down 8 pips. Oil prices jumped sharply, lifting PetroChina and CNOOC by 4.1% and 5.6% respectively. Although OPEC Plus decided to increase daily output by 206,000 barrels in April, this move is negligible compared with the supply disruption threat posed by Iran's potential blockade of the Strait of Hormuz. EIA data showed that average daily oil trade volume through the strait in 2024 was around 20 million barrels, accounting for more than a quarter of global seaborne oil trade. That means the 206,000 barrel per day increase is equivalent to only about 1% of normal strait throughput. Investment banks estimate that a complete 6-week halt in tanker traffic through the strait would push the real-time risk premium on crude to $18 per barrel, raising the possibility of oil prices reaching $100. A report from Fitch's BMI research unit notes that the temporary oil price spike could shave 0.1 to 0.3 percentage points off real GDP growth in several major economies and lift inflation by 1 to 2.5 percentage points. It could also trigger capital outflows from emerging markets, prompting some central banks to end easing cycles and raise rates sooner. Meanwhile, roughly 1/5 of the world's liquefied natural gas passes through Iran. A 1-month disruption in Hormuz shipping could send European LNG prices and Asian spot LNG prices soaring 130% to $25 per million British thermal units. If the disruption lasts longer than 2 months, European gas prices could climb to $35 per million British thermal units. The bankruptcy filing of UK mortgage finance company Market Financial Solutions triggered fresh concerns about the private credit market, sending financial stocks lower. HSBC, BOC Hong Kong and Standard Chartered fell between 4.7% and 6.5%. Although HSBC and Standard Chartered are not major direct lenders to MFS, the market has developed broad worries over underwriting standards in private credit and asset-backed financing. Standard Chartered, with its higher sensitivity to US and emerging market credit risks, tends to come under heavier selling pressure during risk-off episodes. The episode may also prompt UK regulators such as the FCA to tighten scrutiny of fraud prevention, anti-money laundering controls, and operational resilience in 2026, raising compliance costs for large banks. BYD shares bucked a downtrend and rose 4.4%. The company disclosed on its investor interaction platform that it will hold a disruptive technology launch event this Thursday, the 5th. According to the latest industry information and official hints, the new technologies likely to be unveiled include the second-generation megawatt-level flash charging system with peak power expected between 1,500 kilowatt and 2,100 kilowatts, more than 50% higher than the first generation, targeting a charge for 5 minutes, drive 400-kilometer capability that matches the refueling speed of petrol cars. It will use fully liquid-cooled lightweight terminals and a unique T-shaped sliding rail designed to solve the problem of heavy charging cables tracking on the ground. The second-generation flash charging blade battery, BYD's flagship technology, is expected to achieve dual breakthroughs in energy density and charging speed by introducing new materials such as lithium manganese iron phosphate. Energy density will rise about 30% to match ternary lithium batteries. Coupled with a 1,000-volt high-voltage platform, mainstream pure electric models such as the Han and Seal series will see range jump above 1,000 km. The Eye of the Gods Intelligent Driving 5.0 system will introduce an end-to-end large model, high-level autonomous driving solution covering city, highway, and parking scenarios. Laser radar intelligent driving packages previously reserved for premium models will be extended to mainstream vehicles priced around 150,000 yuan, making smart driving more affordable. The 5th generation DM hybrid system enhanced is expected to reduce fuel under low battery conditions to approximately 2.6 liters per 100 kilometer. Several 226 plug-in hybrid models will introduce versions with a 210 kilometer pure electric range, enabling a one charge per week lifestyle for urban commuters. Solid-state batteries and new materials. BYD has confirmed that small batch trial installations of all solid-state batteries will begin in 2027. The 2026 launch event may showcase R&D progress or prototype technology. Additionally, their sodium-ion battery technology aims for a cycle life of 10,000 charges with a theoretical lifespan of 100 years, aiming to significantly reduce the cost of entry-level EVs. This launch is viewed by the market as a strategic move for BYD to fortify its technological moat and counter declining domestic sales. Minimax, leader of China's AI Six Little Tigers, released its first annual earnings report since listing. The report shows strong revenue momentum and global expansion, though it also faces a massive paper loss. For the year ending 2025, revenue grew 158.9% year-on-year to $79 million, driven by improvements in foundation model intelligence and the commercialization of its product suite. By year-end 2025, its services covered over 200 countries, with international markets accounting for 73% of total revenue. Gross profit surged 437.2% to $20.1 million, with gross margins improving to 25.4% due to system efficiency and infrastructure optimization. The reported loss widened to $1.872 billion, primarily due to non-cash fair value changes in preferred shares issued before the IPO. On a non-IFRS basis, the adjusted net loss was $250 million, a slight 2.7% increase. Sales expenses fell by 40.3%, signaling a shift toward organic growth. Cash reserves stand at $1.05 billion, supporting future M3 model R&D. Technical analysis, the Hang Seng Index found support after dipping below 26,000, but failed to hold its 100-day moving average at 26,320, which also serves as the neckline for a multiple head and shoulders pattern. If its breach is confirmed, maintaining the 26,000 level will be challenging. U.S. President Trump stated that the U.S. will continue military strikes against Iran, estimating a 4 to 5 week conflict, but emphasizing the U.S. ability to persist at any cost until objectives are met. U.S. stocks fell sharply at Monday's open, but rebounded as investors view direction as overdone. The VIX rose 8% to 21.44. The Dow ended down 0.2% at 48,904 after being down nearly 600 points. The S&P 500 edged up to 6,881, while the Nasdaq reversed a 1.6% loss to close up 0.4% at 22,748. The Golden Dragon China Index fell 1.1% to 7,198. Corporate highlights: NVIDIA rose 3%. Reports suggest a new processor tailored for OpenAI and inference tasks will be unveiled at next month's GTC conference, utilizing a chip designed by startup Grok. Apple rose 0.2% after announcing the iPhone 17e and the new iPad Air, with pre-orders starting March 4th and sales on March 11th. Defense stock Lockheed Martin and energy stock ExxonMobil both hit 52-week highs amid geopolitical tensions. Berkshire Hathaway fell nearly 5% after Q4 operating profit dropped 30% to $10.2 billion, missing expectations. CEO Greg Abel's first shareholder letter indicated that cash dividends and stock buybacks remain unlikely in the near term, despite the record cash pile of $373 billion. On economic data, the S&P Global U.S. Manufacturing PMI for February recorded 51.6, down from January's 52.4, but above preliminary estimates. The ISM Manufacturing PMI also slightly declined to 52.4, though it still indicates expansion for the second consecutive month. Our stock pick today is Microtech Medical, stock code 2235. Microtech Medical recently issued a positive profit alert. The group expects revenue for the year ending December 31st, 2025 to be no less than 650 million yuan, representing an approximate 88.1% increase compared to 345 million yuan for the year ended December 31st, 2024. Net profit attributable to owners of the parent company is expected to be no less than 38 million yuan, compared to a loss of 63.1 million yuan in 2024, representing an improvement of 101 million yuan. The group achieved substantial revenue growth in 2025 and successfully turned from loss to profit. This was mainly driven by the continued strong revenue growth from one of its core products, the continuous glucose monitoring (CGM) system, as well as highly effective overseas market expansion. The Linux CGM system successfully entered multiple countries, delivering significant year-on-year growth in international revenue. In addition, the continued deepening of lean management and market improvement in operational efficiency resulted in a substantial decline in the proportion of selling and administrative expenses to revenue. The group's products now cover 118 countries and regions worldwide. The Linux continuous glucose monitoring system has successfully entered the medical insurance systems of several European countries and has also completed market access in multiple countries across emerging markets such as the Middle East, Asia Pacific, and South America, providing solid support for international business growth. Recently, the Linux CGM system received marketing approval in Brazil for continuous glucose monitoring in both adults and children. As a core market in Latin America, Brazil offers enormous potential. According to the International Diabetes Federation (IDF) 225 Global Diabetes Atlas, Brazil has approximately 16.62 million diabetes patients aged 20 to 79, with a prevalence rate of 10.7%, ranking 6th globally in patient numbers. In 2024, Brazil's diabetes-related expenditure reached approximately $45.1 billion, ranking 3rd worldwide after the United States and China. The approval of the group's Linux CGM system in Brazil will significantly strengthen its market positioning in Latin America. The group's other core products, the ADEX-X continuous glucose monitoring system and the Equal patch insulin pump system, continue to deepen market penetration. Domestic hospital coverage has exceeded 2,500 facilities, and the products have been sold to 118 countries globally. The Equal patch insulin pump system continues to maintain its leading position among domestically manufactured insulin pumps. In terms of the product R&D pipeline, the group adheres to independent innovation and self-reliant development. The clinical trial of the ADEX-X CGM system for pregnant women has completed all subject enrollments, providing solid clinical evidence to further expand the applicable patient population. The post-marketing clinical trial for the Equal insulin pump system in Europe has completed patient enrollment, supporting potential medical insurance access. Enrollment for the hybrid closed-loop insulin infusion systems indication in children aged over 2 has exceeded 50%. Several other innovative products are also advancing rapidly. Furthermore, in view of the development trend of AI large models in the CGM field, the group has begun strategic positioning by establishing an internal AI team and collaborating with leading domestic research institutions through multiple channels. Suggested buying price $7.5, target price $8.4, stop loss $7.1. I do not hold the above stock.